Hey, Steve Saretsky here. Welcome back to the show. I'm going to walk you through this week why I think the Bank of Canada, who's currently on hold, is going to remain on hold and is not going to hike rates next week. In fact, I would argue that this is the end of the Bank of Canada's rate hiking cycle. Now, keep in mind, this does not mean that imminent rate cuts are coming. It does not mean that the housing bull market is back on. In fact, I would argue far from it. But the Bank of Canada, I think, is done finally and officially. And the reason for that is I'm going to walk you through three reasons this week, three key data points that actually came in that I think the Bank of Canada is going to be paying attention to. And first and foremost is CPI headline inflation. Now, again, you remember it fell down to 2.8%, well within the Bank of Canada's range, which is 2 to 3% range. We pushed back up to 4 on base effects. And the expectation this month was 3.9. We got 3.8. And so everyone's going to say, well, hold on a minute. Well, how can you stop hiking rates when inflation is still at 3.8? Well, the Bank of Canada has a tough job to do, which is to try to model and predict where inflation is going to be 3, 6, 9, 12 months out. And they have to understand that the economy works on these tremendous lag effects. And so one of the things they look at is the 3-month moving average. So Tiff Macklem, that's one of his preferred measures. That fell to 3.67%, down from 4.29. So there's some progress there. But if you actually look at it as we're going to progress through this, some of the largest elements of inflation remain mortgage interest costs, up 30% year over year. That's the largest contributor to CPI inflation as of right now. Of course, shelter inflation, rents are playing a large component to that. I think anecdotally, the rental market is showing some signs that we have probably peaked out and things are now once again stabilizing after double-digit price growth across this country. Which, again, should come as no surprise because we immigrated 1 million people into this country with no housing plan to put these people. So I think the rental market is going to show signs of taming. But more importantly, CPI inflation, which I'm going to get through. The next point being retail sales. Okay, so retail sales have come in flat, in fact, declining over the last couple months. So September, we got the advanced estimate from Stats Canada showing 0, a donut on retail sales for the month of September. Now, again, keep in mind, you have to adjust now for A, inflation, and B, the population growth. So if you actually adjust for that, if you wanted retail sales to just stay flat, normal, like no growth in retail sales, you would need about a 0.5% monthly increase in retail sales to sort of maintain the level of retail sales. Because again, when I say retail sales for September came in at 0, it doesn't account for inflation, the rising cost of those prices, and the number of people living in this country, which is growing at its highest rate in 50, 60 years. So you need about 0.5% growth just to maintain that. So consumers are 100% pulling back in this country, and consumption spending in the Canadian economy is something like 60 to 65% of GDP. So again, if you're the Bank of Canada looking ahead and saying, where is potentially inflation going? Where is economic growth going? That's a pretty clear indicator. So that's kind of sign number 2. Sign number 3 is the Bank of Canada's own business outlook survey. It just fell to its lowest levels outside of COVID shutdowns and the global financial crisis in 2008. The business outlook survey is at its lowest levels outside of those two, I would say, crisis level of events. And so what this is basically telling you is business confidence. It's essentially an estimate, more or less, of how businesses are feeling and where they're projecting future sales. And one of the things that's most interesting about that survey is the Bank of Canada surveys these business owners and they ask them, and the majority of these business owners are saying they feel they have not yet seen the impacts of these rate hikes, but they foresee them coming. So the businesses are saying we still haven't quite seen, in our opinion, the impacts of rising interest rates. So again, keep that in mind that this survey has fallen to horrible looking levels on top of flat and declining in real terms and population adjusted terms, declining retail sales. And yet we have not fully seen the impact of interest rates, and which kind of brings me to the next point, which is, I think, the biggest point when we talk about housing a lot in this video, is you've got about, as per StatsCan, you've got about 10 million homeowners in this country. So you got about 10 million homeowners in this country. Now, about 7 million of them have a mortgage. And so as of right now, less than 45% of people, by the end of this year, Q4 2023, less than 45% of people will have actually seen a mortgage payment increase. So you have basically less than half the market have seen a mortgage payment increase, because you have to think, again, the people that have immediately been impacted is the variable rate mortgage holders, which is roughly about 30% of the market share. But the rest of the fixed rate mortgage share has not seen any payment increase. And so that's going to slowly and steadily increase over the next 12 to 18 months. And if you unpack that number a little bit further, as of right now and pushing through until about August of 2024, of the 10 million homeowners, 7 million of them have a mortgage, 7 million of them. About 1% of those per month, so 70,000 people per month are coming up for mortgage renewal between now and August of 2024. So 70,000 people per month are going to be renewing at substantially higher mortgage rates. And I would argue, again, pretty much minimum a doubling in your mortgage rate, depending on when you got your mortgage. If you locked it in, 2018-ish, you're probably around the 3%. So you're going to get a renewal letter in the mail coming up for about a 6, 6.2, 6.3, 6.4, 6.5% mortgage rate. That's going to increase your payment. So again, if you think retail sales don't look that great right now, you have to ask yourself, well, this is when only 40% of people have actually seen a mortgage payment increase. What happens when you get the other 60% that get a mortgage payment increase? So I still think there is a lot of demand to get squeezed over the next 6 to 18 months. Again, a lot of this, of course, depends on the trajectory of interest rates, but the bond market is doing the job for the central bank. The bond market is pushing yields higher, and that's pushing these fixed rate mortgages higher, and that's creating the real squeeze. So the bond market, the bond vigilantes are doing the work of the central bank. So this is kind of how I'm looking at it. I could very well be wrong. I think I've been wrong on a lot of the pace of the movement of central bank rate hikes. I certainly knew that we were going to get rate hikes. I never foresaw us getting 500 basis points. But I think I'm now at a level where I'm confident that the Bank of Canada is done. But the pain is already done, right? I mean, you're just waiting for the poison to sort of sink in. And so the same thing, the reason why inflation has already done its damage, right? So just because we say, well, inflation's down to 3.8%, again, if we look at the overall growth in prices over the last couple of years, it has largely deviated from its long-term trend. So the overall price level is up. And so when we say you get inflation of 3.8, it just means, prices aren't going up as much anymore, but they're still rising 3.8%. And even when the Bank of Canada gets the target, it doesn't mean that prices came down. They just are only now going up 2%. And so that huge hit to households is not going away. People are stuck with permanently higher prices for goods and services. And I would look at it, again, the same way. The damage is already done on the interest rate side, that you've pushed them up to these very, very high levels, and people that, again, you're just waiting for more and more people now to renew their mortgages. You're waiting for even the people that have renewed their mortgages, that are paying, let's say, an extra $1,000 a month to their mortgage. They're kind of just dealing with it. They're sucking it up and they're paying the consequences, and they're probably, they're slowly paring back on spending elsewhere. And again, I think we're starting to see that in the retail spending numbers. So again, if I'm the Bank of Canada personally, and I was operating the dial at the lever at the Bank of Canada, I don't see how you can continue to raise rates personally. But I think, again, these guys have been wrong a lot. They're not necessarily forward-looking indicators. But for all intents and purposes, I am going ahead and saying the Bank of Canada is done. They're going to move to the sideline. The next move is probably a cut, but it's a cut in 2024 at some point. I don't know if that's Q1 or Q4. That's obviously going to be data dependent. But now you just wait and you let the poison sink in. And like I said, a huge chunk of people are still waiting for D-Day, which is your mortgage renewal day. So as always, hope that helped. We'll see you next week.